Hello and welcome guys to this video. Now before getting into the live search process and getting into the live economic analysis part, we need to understand certain concepts first, right? So today I'm going to discuss in this video two concepts, that is using of quantitative filters, qualitative filters and search database, right? Now on the first topic, that is quantitative and qualitative filters, our objective is to find the final comparable data set, right? And that is where we take a arm's length price analysis, right? In the fourth part in the first part on day 3, what you understood that to arrive at arm's length computation you would require to undertake a functional analysis, that is the factual analysis of the transaction, right? How the transaction is being undertaken between two parties, what are the characterization of these two parties, right? So that was factual part. Now we want to enter into the market. So now we want to assess the market economics for that particular transaction, right? It's not like that we can just write that in report that this is what the market or industry standards are. There's a process for that. And in general, you must have seen that people go ahead with TNMM method or the other method to benchmark the transactions unless the cups are not clearly available. CPM, I haven't seen people using CPM or PSM usually unless there's a special cases, right? So now when we are talking about the external search, obviously the comparables which we find have to be more precise and have to be more they should be more comparable with your taxpayer assessee. Now I'll just start with explaining what are the filters that we need to consider to refine that entire comparable set that we may get from the database. So now as you can see here, there are two types of filters, right? Filters is basically we are refining that entire list of companies to get with an objective that we should get the all, not exact, but broadly we should get the companies which can be compared to a taxpayer assessee or to the tested party. That is what the purpose of this application of this filter is. Now there are two types of filter. First is quantitative filter and the second is qualitative filter. Quantitative filter deals with particular financial data which is available in the database, and qualitative filter is deals with qualitative aspects of that particular comparable company. We'll see that what type of qualitative filters as also quantitative filters are there. So I'll start with quantitative filters first. So quantity, as I said, that you understand that there are certain financial data that you need to understand and that you need to assess, and appropriately you need to take out that company or reject that company from the entire list of companies which you must have got from the search output. We'll also see practically how do we deal with this scenario in the coming video, but this is just for a concept which I'm explaining, that what quantitative filter is all about, right? And what are the types of quantitative filters? There could be many types. I have just taken some generic types of this particular filters. Now, so the first quantitative filter is that financial data for relevant financial year is not available to undertake analysis. So now just assume that you have a data set, right? What is data set? Data set is a list of set of companies with some financial numbers, right? Now when you search on the database, there are list of companies which you get, right? There could be 1,000 companies, 2,000 companies, 3,000 companies, depending upon the query which you give. So basis on that part, you will also get the financial numbers along with that particular company. So there could be also situations where in that data set there is a company name, but there is no financial data available for that particular company in that particular database what we are using, right? And that is where you may not get the financial data for that particular entities, and that is where you need to filter it out. That is, you need to exclude that companies from your final data set, right? When the objective here is to achieve the final comparable data set. So where data is available which matches all the criteria or thresholds that we are going to put. Thresholds is basically filters what we are going to put, and which is functionally comparable to your tested party, right? So the aim is that, so to get to the aim, so to achieve that particular objective, we need to also filter out the list of 1000 2000 companies. Out of 2000 companies, it may be possible that there are only 4 5 or 10 companies are comparable to your particular tested party, and for that we are going ahead with quantitative filters first, and then after qualitative aspects we are looking into the qualitative aspects. Now in the quantitative filter there could be a situation where financial data is not available, and that is where we need to exclude that type of companies. Then after we also move to zero or negative revenue companies. So the companies which technically doesn't generate revenue, that are also required to be rejected from your data set or from your list of entities. Then the companies which have a negative net worth, so there is a negative capital, or say it's a negative net worth, that are the types of companies also we have to exclude from the data set. So once when you see that data set, you will come to know that there are many numbers which also comes up with that data set, which gets generated in a software, that is a database, right? So you will also see that it may generate negative numbers, that is negative net worth, the companies having negative net worth. So we need to exclude that amount of companies also from our final data set. Then there is a turnover filter. So the companies which have a very low turnover, or which may have high turnover, are also excluded, because at certain times companies. So generally, so in general practice, what I particularly take when I am framing a data set is that I will exclude all the companies which have a turnover below 1 crore. So I will not consider that particular companies for comparability analysis itself, and that is where I'll apply a turnover filter. This is a general practice. In general practice also people do take this filter. That is, if the turnover is less than 1 crore, they will not consider that company for a comparability analysis technically. Then sometimes in certain cases you may also apply a 75% operating revenue filter. That is when you are comparing the operations of the company, you also need to ensure that the company is generating revenue from more than 75% of its total revenue from that particular operations. It may happen that at certain times company may earn passive income or probably from other operations more compared to your comparable function or activities which the tested party is undertaking. So at that point of time also you can apply this, you can assess this type of particular thing, and you can reject those companies who are getting revenue more than 25% of revenue from the other activities apart from the its main operating activity. So that are also required to be excluded. Then now let me just tell you also, these are not necessary that you should apply these filters every time. There is no provision to apply these filters, but this is general practice that we do, so that we ensure that our comparable exactly matches to the functions of, not exactly but broadly matches to the functions which are being undertaken by the tested party, right? Then at certain point of time the consultants also do apply the export revenue filter. So in case if your tested party is more engaged into the export of goods or services or whatever is the situation, so they will also see that the comparable company is also substantially involved in exporting of that particular goods or particular segment, right? And that is where they will also apply export revenue filter, that is companies having low export revenue are excluded. This is just to ensure that your comparability is established appropriately. Then there is the most common filter of related party transaction. So once when you understand that there are related parties transactions in that entity, you need to assess that particular part of entities related party transactions, total value of that transactions which affect the profit loss account of that company to the sales. So there will be a ratio of related party transactions to sales, but in that particular list transactions we will only take the transactions which affect the profit loss account of the company. That is also pre-tax, correct? So whatever pre-tax, so for example a rent is being paid to a related party, or goods have been purchased or sold to that related party, then we have to take all these values and we have to compare with the sale value of that particular company in particular year. And we need to understand that if there are high related party transactions, then high means where the related party transactions are more than 25% of their sales, we will exclude that companies as well. So 25% is again not a benchmark number, but general people do generally people do follow this practice where they will try to exclude those companies which influences the sale more than 25% uh, of the entire revenue, right? So that is how they will exclude that part. Now then after, salary cost filter. So at times you may see that there are very, so companies having low salary costs are also excluded. Particularly in practical, I have not used this filter till date, but at point of time, if you find a comparable company where salary costs are too low, while it matches the other criteria, but salary costs are too low, then also I have seen that this type of comparables are excluded. But in practical, I haven't dealt with such situation where I have found such type of comparables. Probably that could be one of the abnormal cases where you may find such type of things, where salary is being paid too low compared to the operations of that company, compared to the revenue from operations from of that company. Then dormant company, obviously these are sick companies which are required to be excluded, because that cannot be economically comparable with your tested party, right? And in special cases, people also check R&D expenditure to turnover. So where but your tested party is not that much into the R&D part, while the other party, the comparable company, is more into R&D part, or is he's incurring much expenses on R&D expenditure, then a particular observation may be made to that particular part, and if that is not comparable with your functions, you may exclude that. These are just generic filters which I have gathered from the public domain, also certain from material, also reading material also. But yeah, these are generic filters which are used uh, to refine your data set. Let me just put it that way, right? So these are quantitative filters. I'll catch you in the next video where I am going to discuss the qualitative aspects, right? We are done with quantitative filters, where we are assessing the quantitative aspects of that particular financial data, or particular comparable, right? Now we will go ahead with the qualitative filters in the next video. I'll catch you in the next video. Enjoy and thank you.